Hello, this is Lara with your end of the week video for the gold cash market for the trading week ending Friday, 5th of July. A really strong downward day for Friday with a strong push from volume suggests that the back test that I was expecting after that very significant breakout may be incomplete, or it's also possible that the bearish Elliott Wave count could be correct. I'm going to look out for another test of support to relieve extreme conditions. Support is about 1360 to 1385, and the price point which differentiates the bull and bearish wave count is 1346.45. That's a really important price count, and I am going to ignore this price spike on bar chart data. I've opened a support ticket. They're going to follow up, and I expect it will be gone after the Monday or Tuesday session next week. Bar charts do have these price spikes in their data for this market from time to time. Often they remain, sometimes they disappear. This is the most extreme one I've ever seen, and so I'm really suspicious of it, particularly suspicious because it does not appear on all time frames. When they're not so extreme and they appear on all time frames, I take them into account until they disappear, which sometimes they do, but not always. This one I'm going to ignore. At the weekly chart level, this is, at this stage, my tentatively preferred Elliott Wave count. It sees gold still in a bear market, but I say tentative because the breakout above multi-year resistance had support from volume, and from a classic analysis perspective, it absolutely needs to be taken very seriously indeed. After a breakout above multi-year significant support, it's pretty normal to see price curve around and test support before it moves up and away. And so some downward movement was expected, and that may be what we're getting. Now, if price moves back below support, and it does so with strength, this would be the wave count that I would then have a little bit more confidence in. But in order to have reasonable confidence in this wave count at this stage, it absolutely needs to see a new low below 1346.45 by any amount at any time frame. A fraction of a cent on a tick chart is enough to give me confidence in this wave count, because the Elliott Wave rule I'm using is absolutely black and white. This wave count sees gold as within a three-step back pattern. In other words, it sees the bear market for gold is not over at this major low in December 2015. It sees that as only a five-wave structure for wave A, and here's wave B, and now we're looking for wave C to move below the end of A, quite substantially possibly. Wave B structure here is seen as a double zigzag. That's a fairly common structure, but the problem with this wave count, and the reason why it wasn't my preferred wave count, is the structure here of primary wave X. Within double zigzags, X waves are almost always brief and shallow single zigzags, but here primary wave X is seen as a double combination. There is an Elliott Wave rule regarding multiple corrective structures, combinations. The maximum number of corrective structures within a combination is 3, and that count refers to W, Y, and if there is one, Z. It does not include X waves, otherwise obviously the total count would be 5, W, X, Y, X, Z, but the count is 3, which means to meet the Elliott Wave rule, X waves can subdivide as any corrective structure. My research shows they are almost always single zigzags, but sometimes they can subdivide as another corrective structure, like a flat, a triangle, or a combination as seen here. The structure of primary X is a double combination with the first structure, a zigzag labelled intermediate W, the double joined by a 3 in the opposite direction labelled X, which subdivides as a single zigzag. That's the most common structure for it to be. And here the second structure is a flat correction subdividing 3, 3, 5, labelled intermediate wave Y, ending around about the same level as W. The whole thing has a sideways movement, which is normal looking for a combination. Cycle wave B is a double zigzag, W, X, Y, and it may be complete here. If it's going to continue higher for this wave count, It would have to be as a very rare triple zigzag. I have seen a very few triple zigzags, but they are very uncommon. And so the probability, if this labelling is correct, the probability that cycle B is over should be very high. And cycle C should be beginning downward. Cycle C needs to be a 5-wave structure, which is either an impulse or less likely an ending diagonal, and it should move below the end of A to avoid a truncation. Let's take a look now at the daily chart from the high of cycle B here, this point up here. Cycle primary wave Y subdivides as a zigzag 5, 3, 5. Intermediate C for this wave count is seen as a complete impulse 1, 2, 3 and 4, very brief and shallow, seen best at lower time frames, and 5. This is a really normal look for gold's impulses. More time consuming and deep second wave corrections to start the impulse, accelerating toward the end of the third wave, forcing the fourth wave coming just after to be really brief and shallow, and that gives gold's impulses a really typical curved look to them. And at higher time frames they look like 3-wave structures. You could try and count this as a zigzag, but my experience with this market shows that this is a really normal looking impulse for gold. If cycle B is over here, then within cycle C it should subdivide as a 5-wave structure. I'll label and expect it to be an impulse unless and until overlapping suggests I need to consider the least likely ending diagonal. So far within an impulse, minor wave 1 may be over here, minor 2 very typically very deep, may not move beyond the start of 1 if it continues any higher above the invalidation point. At the hourly chart level, here's the end of minor 2, and you can see at this time frame that big price spike is not evident. It's not evident off to the left of the chart either, and I've checked really carefully. And that's what makes me really suspicious of that particular spike, and I'm going to ignore it. Minor wave 1 may be over here. Minor 2 may be a very typically deep second wave to start a new trend. For gold's new trends, the first, second wave corrections are almost always very deep indeed. Minor wave 3, I'm calculating the target for it to reach the most common Fibonacci ratio to minor 1. But if this target is wrong, it may not be low enough, because when a second wave correction is very deep, the third wave is often even a longer extension. In order to move far enough below the end of the first wave to allow enough room for the following fourth wave at minor degree to unfold and remain below first wave price territory. Within minor 3, I expect minute 1 as an incomplete 5-wave impulse, subdividing 1, 2, 3, 4, 5. As soon as 5 moves below the end of 3, a truncation would be avoided, and minute wave 1 may then be complete, and then I'll look out for another bounce for minute 2 to unfold and to not move beyond first wave price, the start of minute wave 1. When minute wave 1 may be complete, I'll draw a Fibonacci retracement along its length, and I'll use the 0.382 and 0.618 Fibonacci ratios as targets for minute 2, favouring the 0.618 Fibonacci ratio. This wave count is almost identical to that last daily chart I showed you. At the weekly chart level, it's almost identical, but instead of seeing cycle wave B over here with 1, 2, 3, 4, 5, what if this was wave 4, and what if wave 5 is continuing to make a final high before this upward movement is over? I've calculated a target for minor wave 5 to reach 2.618, the length of minor wave 1. But the size of the sideways movement now for this wave count is starting to not look right. If minor wave 5 is unfolding, I wouldn't expect it to have these big, deeper and more time-consuming pullbacks showing up at the daily chart level. I would have expected it to just move quickly higher to end the movement. That's not what's happening. However, this is still entirely possible. Let's take a look at this at the hourly chart level, where minor 4 low is this point here. Minor 5 may be unfolding as an impulse, 1, 2, it needs 3, 4, 5 to complete up toward the target. 2 may not move beyond the start of 1, below the invalidation point. At the weekly chart level, this is my bullish wave count, and if your own personal analysis supports a much more bullish outlook for gold, then this may be the Elliott Wave count you would choose to use. However, it does suffer from a pretty serious problem in terms of Elliott Wave. I showed you on my first daily chart a very typical looking curved impulse for gold, and here's another example. Here is a curved looking impulse for gold. 1, 2 is deep and time consuming, 3 ends with strength, forcing the fourth wave coming just after to be more brief and shallow, and then 5 ends with strength. That's because gold, typical of commodities, exhibits swift, strong fifth waves, and that tendency is especially prevalent for its third wave impulses. The fifth wave in here to end -3 was very swift and strong, forcing -4 to be brief and shallow. It gives gold's impulses a curved look. That's absolutely normal. What isn't normal is the opposite, where the fourth wave covers a greater distance in terms of price and is more time consuming than its counterpart second wave. This looks quite wrong for this market. This is a substantial problem for this wave count and reduces its probability despite the very significant upward breakout. In terms of simple classic technical analysis, I would put a lot of weight in that upward breakout. It has support from volume. This could be the right wave count. That's the problem with probability. This, in terms of Elliott Wave, I still have to judge in Elliott Wave terms to have a lower probability. I will not discard it though, while price remains above 1346.45. I am ignoring this spike here. But the problem with low probability outcomes is they do sometimes occur, and when they do occur, they will never be what you expected as most likely. That's how probability works. So if it turns out that my bearish wave counts are invalidated, leaving only this bullish wave count, then at that stage, the lowest probability Elliott wave count would be the sole remaining correct wave count. It doesn't mean the Elliott wave analysis is wrong. It just means a lower probability outcome has occurred. It's a bit of a difficult concept, it seems, for some people to grasp, but there it is. That's the way it works. The target for primary 3 is to reach the most common ratio to primary 1. I'm seeing the bull market beginning here. 1 cycle degree, 2 a double combination, and 3 needs to be an impulse. So far, primary 1 and 2 may be complete. Primary 3 has a target, a Fibonacci ratio to primary 1. When it's complete, primary 4 should then unfold and remain above primary 1 price territory. This is cash market data. I will not allow any overlap by any amount at any time frame. A new low below this invalidation point, even by a fraction of a cent on a tick chart, is enough to invalidate this wave count. And that's why a new low below that price point would give me so much confidence in a more bearish Elliott wave count. While price remains above this point though, I am going to take this upward breakout above multi-year consolidation quite seriously. And we'll see why when I get to the classic analysis targets. The target for cycle 3 is extremely bullish. It's for it to reach 1.618, the length of cycle wave 1 from this high to this low, applied to the end of cycle 2. That's how I calculate the target. At the daily chart level, let's look at the start of primary 3 from the end of primary 2, this point down here. Primary 3 for this wave count would probably be incomplete. It needs to move further above the end of primary 1 to allow enough room for primary 4 to unfold and remain above first wave price territory. And so I'm counting primary 3 as an incomplete 5-wave impulse. 1, 2, 3, 4, and now looking possibly for further strength and upward movement. because gold, typical of commodities, likes to exhibit swift, strong fifth waves. And that tendency is especially prevalent for its fifth waves to end a third wave impulse 1 degree higher. And that's what intermediate 5 is. It's a fifth wave to end primary wave 3 1 degree higher. It could exhibit quite a lot of strength. If the target is wrong, it may not be high enough. At the hourly chart level, here's the end of intermediate 4 and the start of an intermediate 5. Minor 1, minor 2 should now be complete. Minor 3 for this wave count needs to move higher and needs to move above the end of minor 1. Let's have a look at that breakout because it's actually really technically significant and it needs to be given weight. Here is multi-year resistance at 1375. When we look at this breakout above resistance at the daily chart level, the day it happened had good support from volume. An upward breakout needs to have support from volume in order for confidence, and this one does. Next resistance, reasonable resistance, is at 1432, and above that, even stronger resistance at 1525. Volume supported upward movement for May, but if there was a further increase in volume, this chart needs to be updated. This candlestick was complete and it did show a further increase in volume, and so the upward breakout at the monthly chart level also has support from volume. That's a very, very bullish situation. On balance, volume has some bearish divergence though between these highs here and these highs here, not shown on the chart because I don't give it too much weight, but that would tend to suggest or put a little bit of suspicion on the upward breakout. But because it has such good support from volume, I'm not going to put too much weight on this bearish divergence. On balance, volume at the monthly chart level remains constrained, below resistance and above support. I put more weight on how on balance volume behaves with its trend lines than I do on divergence between it and price. ATR has been declining for some years in this bear market, supporting the idea that this may have been a B wave within an ongoing bear market. If ATR starts to show a reasonable increase, then we may have seen a slow beginning to a new bull market, if this is a major low back here in December 2015. RSI is neutral, there is still room for price to rise or fall. Stochastics also remains in neutral territory, and I'm adding here the correlation coefficient between gold and US dollar index and gold and oil. Currently, they do not have a statistically significant correlation between these markets, and when a correlation does appear, it is not reliable. And so I'm not basing my analysis of any of these markets on my analysis of another, because they're not correlated. ADX at the monthly chart level is too low to indicate a trend. It's below 15, and the DX lines have been whipsawing for quite a long time. At the weekly chart level, last week there was a bearish upper wick on the weekly candlestick suggesting some downward movement. I said to expect a back test of support after we got this breakout, which has good strong support from volume. After an upward breakout, it's really typical to see price curve around and test support. Support here initially at 1377, also below that about 1360. There's a strong band of support here which needs to be properly tested. It doesn't look like after Friday's downward day that back test of support is quite done yet. On balance, volume is at weak support. For Friday, price fell of its own weight. This is not a particularly, for the last week, price has fallen of its own weight. This is not a particularly bearish weekly candlestick. ADX is increasing, telling us there is an upward trend. So that tells us to expect downward movements or counter trend movements at this time frame. ATR finally is starting to show some real increase after declining for a very long time. There is strength in this upward breakout, so we need to take it seriously. But RSI is overbought, as is stochastics. A better back test may relieve extreme conditions. MACD full ball bullish. What about the shorter term picture at the daily chart level? There's a candlestick reversal pattern here at the high and another one here with a long bearish upper wick, telling us to expect some downward movement. Friday's candlestick is particularly strong. Volume is actively pushing price lower. It's a bearish engulfing candlestick pattern engulfing more than one of these prior candlesticks here. This is a very bearish candlestick, although it does have a slightly bullish long lower wick. Price supports or pushes, volume pushes price actively lower. That's very bearish for the short term, and that's what makes me think that this back test of support is not quite over. It may continue further to relieve extreme conditions further, particularly at the weekly chart level. So the backtest may continue now for another maybe 1 or 2 weeks. How price behaves when it gets back down to support 1375 to 1360 is going to start to indicate which of those Elliott wave counts should be considered most likely. RSI back into neutral territory, ADX declining, telling us the prior upward trend reached very extreme and may now be over or interrupted. ATR showing a strong increase still. Stochastics back into neutral territory. And MACD still bullish but not full bore bullish. It looks like we may about to get a crossover, but it hasn't happened yet. That's all for me with your gold analysis this week, and I hope all our members are having an awesome weekend.